Today, we are going to be talking about distressed properties, especially foreclosures and powers of sale.
Isn't Shark Week in July, though?
Well, you know how the saying goes, buy whenever there's blood in the water.
I think it's by when there's blood in the streets, actually.
I think it's kind of the same thing when half the country is either drowning in debt or treading water and inflation, thanks to monetary policy.
Yep, that's true.
Based on the questions I'm being asked and the sentiment that I'm hearing and the data that I'm seeing, the perfect week for sharks in the real estate industry could actually happen this year. But in all honesty, folks, we don't encourage ambulance chasing or bottom feeding on this show. Sharks eat bottom feeders anyways. However, the data is showing an increase in VTBs or vendor take back mortgages. So for those of you who want to know what that is, episode 46, we go through it in pretty solid detail. We are seeing an increase of VTBs being offered in the market, and we're also seeing an increase in power of sale listings in some markets as well. So today we're going to give you a lowdown on how to find and buy those specific distressed properties and what those distressed sellers might be looking for in offers based on their position. So how to offer on these properties based on what we know about, that distress, let's call it in quotation marks. There are a few data points specifically that made me want to do this episode. Everyone's always asking me how to find foreclosures in Ontario. Well, the truth is they actually don't really exist in Ontario, but we're going to get to that later. So I did some research seeing whether or not we're seeing an increase in distressed property listings, and we are in Ontario at least. But before we get to that specifically, I want to set the stage a little bit by mentioning a little cultural norm in the real estate industry called the 3Ds of real estate. Nick?
The 3Ds of real estate: death, divorce, and Daniel Foch. Wait, no, that's not right. Just kidding. Death, divorce, and debt. And starting to sound a bit like ambulance chasing that you mentioned here, Dan.
Yeah, well, let's start off with death then. The owner of a property dies, and the estate who is inheriting the property decides to sell the property, usually because they can't afford probate or the taxes and need to dispose of an asset to fund the real estate transition or transaction, because you often have to pay tax in the transfer. Probate is the approval process that takes place in Canada, which validates your will and confirms the appointment of your executor of the will. So that's the person who will kind of distribute all of the assets within the estate. This process is usually undertaken by an experienced and expensive legal professional.
Let's move on to the second D, divorce. I mean, no one loves talking about it, but it is a very relevant subject these days. So you've got a property, the two owners are divorcing. That leaves them with two choices. Either they do a buyout or they agree to sell the property.
So it's actually funny. Did you see that Instagram story by Jeff Margolis? He was like, Dan's the kind of guy who goes to weddings and is like,
Yeah,
50% of these end in divorce. Eh? Hey, statistically, leading cause of divorce is marriage. Number three here, debt.
You're not making a speech at my wedding there, by the way.
Well, I feel like the debt part's pretty much self-explanatory, but it can end in two different formats, which is foreclosure versus power of sale, which we're going to get to. They're distinctly different and should be handled as such.
Yeah, so each one of these types of transactions can be fickle and they require a different set of gloves to handle. For example, if you're trying to buy an estate from an estate, the estate is likely working with a lawyer, a trustee, or an executor to communicate the offer to its inheritors, essentially brokering the deal. Estates are complicated and they have to follow a very specific process. And that goes something like this: authenticating the will, appointing an executor or representative, posting a bond, locating the dead person's assets, determining the date of death values, identifying and notifying creditors, paying debts, preparing and filing tax returns. Then finally, you get to distribute the real estate. Or sorry, not even the real estate, just the estate. And hopefully there's real estate in the estate.
So estate sales may not be looking for more complications per se. They like clean offers with very few conditions. They're typically not in a hurry because the property can't close until the process is complete, and they don't know when that is. So estate sales value flexible closings rather than fast closings, even though the house is probably vacant.
And for people selling estates, they can be a lot less price dependent because you have to remember they're getting a windfall of money that they weren't really anticipating. And it comes with a period of grief. I mean, someone literally died.
Yeah.
And then on the other hand, in a divorce, each divorcee is likely being advised independently by a lawyer who's basically translating your offer to the sellers. They may care less about the conditions and closing date or be very specific on price because they each need to walk away with a certain amount of equity to start their new financial lives. Flexibility in both cases is going to be valuable. Dan, tell us about the final D.
The final D is debt. And if you haven't noticed already, this is what the remainder of the episode is going to be about. So I'm going to pull up a report called CMHC's Residential Mortgage Industry Report. You can find it on Google by searching the report by the same name. CMHC puts this out on a quarterly basis. Or again, if you want to subscribe to the Patreon, if you want to watch along to see all of the charts that we're going to be using throughout each episode, then there'll be a link in the show notes to that. So this chart heading shows annual bars indicating mortgage delinquency for each type of mortgage under 4 different categories. The first one is chartered banks, which is less than 0.2% delinquent. Credit unions is even less delinquent than that. And then we have other non-bank lenders like MFCs, trusts, insurance companies have a delinquency somewhere between chartered banks and credit unions. And then finally, the most delinquent and still less than 1% is MIEs or mortgage investment entities like MICs, mortgage investment corporations.
Yeah, the chart heading reads, mortgages in arrears delinquent for 90 or more days continued its downward trend across all lender types. So your chartered banks would be, like, the list includes colloquially known as the Big Five in Canada: RBC, TD, Scotia, BMO, and CIBC. And then their, quote unquote, second tier HSBC, National Bank, Laurentian Bank of Canada, and Canada Western Bank.
And next on the list is the credit unions that we discussed. And I actually really like talking about credit unions because I think for local investors, we have to remember credit unions do have a mandate to recirculate or reinvest capital that they get, the deposits that they get into that local community. So they're often really, really good lenders for local real estate investors who are trying to create housing for that local community. The top 1 to 3 credit unions in each province based on asset size, and in the top 100 largest credit unions. So these are within the top 100 largest credit unions in the country. In British Columbia, we have Van City, Coast Capital, and First West Credit Union. Manitoba, we have Steinbach, Assiniboine, and Cambrian Credit Union. In Ontario, we have Meridian, Desjardins Ontario Credit Union, and Alterna Savings. In Quebec, Desjardins Group includes 219 Caisse Populaires, which is the Franco version of a credit union, mostly located in Quebec and Ontario, who serve almost 5 million members. In Alberta, we have Service, Connect First, and Vision Credit Union. In Saskatchewan, we have Connexus, Affinity, and Innovation Credit Union. In New Brunswick, UNI Financial Corporation, Financial Cooperation, and Bayview Credit Union. Nova Scotia, East Coast, and Credit Union, Atlantic Credit Union. Newfoundland and Labrador is the Newfoundland and Labrador Credit Union. Great name. And PEI is Provincial Credit Union.
Yeah, next is the other non-bank lenders, such as insurance companies like Desjardins outside of their credit union division, GWL or Great West Life, which we should all be familiar with. They're large in both the insurance and lending space. And then alternative lenders like EQ Bank, Quest Mortgage, Home Trust, FizGuard, First National, Firm Capital, and MCAP.